Hey, everybody, Kevin Shortle here once again. Yes, I know it's been a while. I took a brief break from the podcast, but we are gearing up. In fact, we have a special series coming up I'm doing with my friend Dave Franicki. And Dave's a well-seasoned investor in both real estate and real estate notes. So we're going to do a whole series on how you should protect the investments that you have in the note business right now, but also how to prepare and really flourish in the future, because we are facing inflation right now. We are probably already in a recession. The numbers aren't going to reflect that yet because we're always looking back on those numbers. And Dave and I have been through enough crashes and such in our investment life that we're much better prepared this time around and know what we're facing. And we really wanted to share all that information with you. We're going to be doing a whole series. As I said, we're going to invest guests in from time to time on that topic as well, because we want my listeners and our clients, Dave's clients, my clients, to be the best prepared that they possibly can. And hey, the good news is, if it is a soft landing, if inflation starts to mild, we don't get into a recession, you're still going to learn valuable skills just in case it did. If it doesn't happen, you've gained a lot of knowledge because businesses always go through cycles. Before we get started here, I want to thank my sponsor, Noteworthy, noteworthyusa.com. You can go to noteworthyusa.com and learn about what we do for the industry. We focus on real estate and real estate notes. We have a couple of national events per year. We've got one next coming up in, I believe that's going to be in October or November in Orlando, Florida. I'll be there for the entire time, as the whole team will be. So if you're interested in that, go to the website, noteworthyusa.com. And also the newsletter. We have a monthly newsletter. It's the best in the industry. And the June newsletter is coming out in just a few days. And I am featured on the cover this month. So I'm going to have some links on the YouTube channel. I'll have them in Twitter and all the other social media that I'm on. And hopefully you're following me on all of that. I'll have a link on there where you can get a free copy of the newsletter. And then if you wish to subscribe from there, you certainly can do that. So thank you, Noteworthy at noteworthyusa.com. All right. So Dave, how are you, my friend?
I'm doing great. How are you, Kevin?
I'm doing good. I'm looking forward to this series. How about you?
It's going to be fun, and I think we'll learn a lot together. And I hope, and I would assume that the folks listening in will learn a lot also in terms of how to pivot as needed and make money.
Exactly. And Dave, I know people are going to want to reach out to you as well. And I'll put your email address and your URL on there as well. But where can people find you for looking for assets and such? That's really what you specialize in.
Yeah, they can email me at my name, dave@davefranicki.com. They can call me. I need my cell phone. A lot of that stuff is on my Capstone Capital website, capstonecapitalusa.com. So between those, they'll be able to find me. My number is 480-232-5477, but you put that on the screen.
Fantastic. And we also, by the way, on this series, I can tell you, Dave is sending me probably 3 or 4 emails a day right now in researching everything and looking at all of these numbers on the inflation again, recession and house pricing and bubbles and all this other stuff that's so important. So it's going to be a good series, a special series that we'll pepper into the Real Estate Without Renters podcast here. But we do have a special guest on. He's been patiently waiting for us on your screen there. Dan Krasnowski is with us, and Dan has a very, very impressive background and is very well versed in really, I would say, just all alternative investments, real estate included, but all different fractions of real estate, and from commercial to warehouses and funds and everything else. And I'll let him go into to more of that. But it's a pleasure to have him on here because he's going to enlighten us on raising capital, a little bit of that, investing, where investors are looking now, some things about the economy and what his experience has been through these times as well. So Dan, welcome.
Awesome. Kevin, such a pleasure to be with you and Dave today. Thanks for having me on.
Oh, you're most welcome. Looking forward to it. Let's give a little bit of a background, if you wouldn't mind, because you have an impressive portfolio with storage units and multifamily, and you're an equity owner in companies. You're a passive investor, double-digit returns. I mean, everything investors that listen to this podcast are looking for. You have been certainly highly involved in. So, why don't you give us some more detail on that?
Yeah, absolutely. So, I think like any Gen Xer, you want to be the opposite of your parents. And I say that a bit tongue in cheek, but, I grew up in Scranton, PA. My grandparents' generations were the ones of the entrepreneurs, trading slices of meat for clothes in the Depression, working the coal mines, owning land. All of this was second nature, to them. Whereas I think my parents' generation, my mom was a social worker, my dad was a high school principal. I kind of feel like I'm a chapter in Kiyosaki's Rich Dad, Poor Dad book here. And no matter how many fancy degrees I get, what you grow up with is your mindset for a while. So it took me a little while to break out of that. But, ultimately my DNA is helping out the small person and thinking outside of the box. So, with that, although, the first part of my career was very standard, GE, Merrill, very corporate, probably the life that many of us with a little bit of gray hair had until 2008.
Mm-hmm.
I just had the benefit of coming to Austin in 2011 and, really getting to put my money into alternatives, doing crowdfunding before the Jobs Act was out, and raising capital before I really knew I was raising capital for folks, just a guy who I thought was a great operator. Long story short, he just exited for 9 figures. So looks like I got on the right horse. And, like anything, I think when your hobby becomes your livelihood, that's a pretty good way to play it out. So that's.
Did you start, for example, with single family homes or
so as a passive investor, in my golden moment, I was best man in a wedding. The other gentleman, I said, "What do you do?" He said, "Flip houses." I'm like, "Yeah." He said, 15%. My ear sprung up. He said, "Did you know you can use your retirement dollars?" And that was my golden moment to this huge, pool of money that I thought was stuck in the Fidelity, year 2100 fund or something.
Yeah.
So my first LP investments outside of a comedy tour and some light restaurants and stuff that I'd say serious money about was single family, was a fix and flip.
Okay.
And then from there, I said, this gentleman and I have a great relationship, but I've been more focused, I'd say, on commercial from a capital raising side and otherwise since then.
Yeah, more money to spend. And I think that's common with all three of us. Dave, you started in single family too. Am I right on that or wrong?
Yeah, I started in single family building and development. And
Right.
2008 happened. And then I used my license, selling REOs and things like that. And then the note business.
Mm-hmm.
Yeah, it was single family foundational construction back in the day, but it's been construction and now paper related.
Yeah. And Dave also got into self-storage too.
I have a very small facility.
Yeah.
Not like Dan has,
Yeah.
but very, very small facility in central Maine. And I've been playing with that. I'm selling that now.
Right. So Dan, with you, so you have Rocket Dollar, and Rocket Dollar is your self-directed IRAs, 401ks, retirement accounts. Is that correct?
That's correct. So Rocket Dollar, it's a checkbook control self-directed shop. So it offers both the self-directed IRA, but with checkbook control, and the solo 401k, also known as the individual 401k for folks with qualified self-employed.
Right. Just an observation, and I don't know what your thoughts are on this or what Dave's thoughts are on this. There's so many people in the note industry, in the real estate industry, they always talk about self-directed IRA. And if I compare self-directed IRA with self-directed 401k, 401k is just, you can have both, but I mean, 401k is leaps and bounds better. And it seems to me to be off the radar screen for most people, where I think they just somehow think that it's complicated or something.
And there's a few reasons behind it. I mean, taking it a step back, how come outside of our close network, people haven't heard of self-directed IRAs? Ultimately, it never behooved big Wall Street, Fidelities of the world,
Sure,
to educate on this. So there's an awareness. Now, once you get through here, the next term is the self-directed IRA. It's basically the Gatorade product. It's been around 50 years. And that said, for the model of it, the traditional custodians, and I have a lot of good friends that work here in the space, it's a factor of number of transitions, asset under management, which feels a little antiquated to me. In a checkbook control, more the solo 401k that you referenced, the custodians would not have access to that information. So part of it, it just doesn't fit with the historical revenue model. Now, all that said, I think COVID pulled the curtain back on a lot of things per se. And a lot of us, for better or worse, have some self-employed entity and are learning of the solo 401k based on one name or the other. And to your point, just seeing the huge benefits, whether it's from the 100,000 plus contribution for husband-wife team, or a solopreneur that doesn't really want to formally raise money but borrow 50K from himself. If it goes well, great. If not, hey, you're back in a W-2 schlepping around, so you'll pay it back that way. So you're right, just tremendous benefits here, and always happy to share more.
Yeah, great. And those accounts, of course, most of my listeners understand that you can choose the investments you want to be in. And I'm curious, and Dave, you probably have some follow-up questions on this too, but even on your website, and by the way, the website that we're talking about right now, one of his companies, we're going to talk about his fundraising capital side as well, but rocketdollar.com is the website, well done website. And you can see on there that people are allowed to invest in whatever they like. And in fact, your job, of course, is not to decide whether that's a good investment or not. Your people have to decide, is it an allowable investment? And pretty much the list is much shorter as to what is not allowable, but we don't have to go into all of those. But I wonder if you notice any changes to that. So people can invest in crypto, peer-to-peer loans, real estate, precious metals, private equity, small business, startup, all these different things. And I'm wondering if you've noticed a change, if you have reports or anything, or industry wide, are people starting to shift right now, starting to really start to see what might be coming down the road, and looking to protect what they have and to keep their money growing moving forward?
Yeah, so I think two things over the last, let's say, 18 months, one of which is crypto. Now, particularly as crypto went up, I think a majority of folks were still at home-ish, say first quarter last year. In hindsight, you could say buy high, sell low. But I think for a long-term play, folks said, wow, I want a certain percentage of my assets, of my retirement assets in crypto. So crypto was a huge push to open, boatloads of accounts, to be honest with you. Mm-hmm. Now, obviously, with things going down, I think some folks that can think, clearly when the markets are down, still may want to open for crypto. That said, I think more folks are looking into real estate, and not just real estate, but I said some of the notes that you guys do, the short-term cash flowing things that pay a monthly distribution, are the types of investments that are becoming the initial investment in one of these accounts.
Mm-hmm. And the process, once again, is not difficult. I think when people think in terms of IRAs, oh God, now there's a bunch of paperwork and I got to file. What's the process if somebody has money in Rocket Mortgage, or sorry, Rocket Dollar, Rocket Dollar with you there, and they want to buy a note, let's say a real estate a note? What's the process that they work with on you?
Yeah, I mean, once the account is open and funded, it's just as easy as your piggy bank checking account. Meaning, from the, not counting the subscription doc, let's say, but from the wiring perspective or sending money, it's literally real time. I mean, the gentleman who I referenced before, I think collectively we've done 29 transactions, and there's times I get a text at 8 on Sunday night, and he says, hey, you want to be my rounding error for X thousand in this deal? And I go online, boom, we're good to go.
Yeah.
So my point here is I started accruing on that day, myself and him go into the office Monday morning. We're not sitting on the stack of paperwork that we have to fill out for a third party just for sake of. Mm-hmm. None of that is there. So the checkbook control, and if you read, especially some of the capital raising books, from the 2010s throughout, there's a fair number of chapters that will talk about self-directed IRAs. And when you really get close, one of the few bold-faced sentences is about checkbook control, both for the investor and then also the sponsor. Mm-hmm.
Mm-hmm. And Dave, you've done, gosh, as far as I know, pretty much all the last investments you've done have all been through your retirement type of accounts and going above IRAs and 401ks even, right?
Right. Yeah. I'm working in a Roth with a personal property trust with a trustee. You're probably familiar with that. And it's just a ton of flexibility. I pay my trustee a little bit, but it's good. But what I'm finding, and Dan, maybe you can help me here, a lot of these folks that have an IRA and they want to buy in their IRA custodian gets involved in determining if those notes are worthwhile. and you've got the big company in Northern Ohio. You know what I'm referring to.
Yes.
Okay. I saw your eyes.
Yep.
And there's others that it's challenging. So how is what you're doing different? Is it because it's checkbook controlled or what?
Yeah, I like to say we're taking mom and dad out of the equation. So, fun analogy here. It's almost if you left $100 on your dresser and you were in college and your parents are going to ask you 100 times if you're using it to buy beer. The answer is probably yes, but it's my ways. Just put it in, dating myself, put it in the envelope, send it down to me, and we're good here. So you're not going through the dog and pony. Once again, a custodian, just to be clear, cannot tell you what to invest in. They cannot give you advice otherwise. It's for sake of filling out, a majority of the time, their paperwork or their, check the box list per se. So what's the net effect? It's a lot of delays. It's banker hours on top of everything. On the flip side, with a checkbook control account, as it sounds, you have access to your money 24/7 to invest in what you want, when you want. And Kevin, I know you shared before, there is a list of what you can't do, but it's relatively short. So I'm going to go through it real quick. No life insurance, no collectibles, and not yourself or your linear family. So what does that mean? Not your primary residence, not a beach house that you're going to go to, not a flat for your parents to stay in when they come to visit, not your child's lemonade stand startup. Everything else, when I mean everything, as Kevin referenced before, notes, loans to female entrepreneurs, startups, international equity. You want to own a condo in the Caymans as a rental? Go for it. All of this is allowed within this window. And then with the checkbook control, it's just the timing of it. I mean, I'll probably do stuff. I'll write a check on June, by writing, meaning wire money, on June 30th of something that I'll probably finish the subdocs on the 29th or the morning of the 30th. I mean, it really is that easy.
Just going to follow up on that then. My example of the big Titanic out there doesn't pertain to you because it's checkbook controlled. So as a parallel though, my PPT and your self-controlled LLC checkbook control they are parallel.
Yeah, a checkbook control self-directed IRA with the LLC model is very similar to the PPT. And then by default, the solo 401k by definition does not have a custodian. I mean, it's basically, as individuals, if you were to have a health savings account, use it for medical, don't use it to buy a new car, the relatively simple rules of what not to do. And what we've seen, of course, at Rocket Dollar, and we'll give guidance, of course, in the sales process and in the fulfillment process. If somebody's like, "Oh, I think cannabis is okay," there's times when we may not open something for that, or somebody's like, "Oh, I'm going to buy a house and live in it," or my parents. We'll refer them to. We actually, I commend Brendan Walsh and the team, an award-winning knowledge base that, as much as legally that could be shared or that we verified, is out in the knowledge base, which is rocketdollar.com/learn.
Okay, so as a follow-up to that, does your company work with the Roth?
Absolutely, yeah. And there's two ways to go. I mean, one is just the self-directed Roth IRA. So, for example, my personal situation, my dad said go to the bank and had a Roth IRA at my hometown bank. It made it to a Fidelity Roth IRA, and then it goes into a Rocket Dollar, self-directed Roth IRA.
That's that. Okay, we're on the same page. I understand.
Absolutely. And a final cherry on top with the solo 401k, in layperson's terms, you have a pre-tax checking and a post-tax checking. Let's just use round numbers and say you fund with 100K and you find, let's just say a startup you think is going to be the next Facebook, and you're going to invest $10,000. Literally with the click of a button, you move $10,000 over to the Roth. Now that said, come tax time, your AGI is going to go up by this 10K, but you're effectively doing Roth conversions on the spot.
Got it.
It's really cool.
That's unique. I like that.
Wow. Let me just, for clarification for some of the listeners there, you heard some terms that you may not be familiar with. PPT, personal property trust, is a way that you can invest in personal assets such as notes, and you can do it with anonymity, ease of transferability. So it gives you privacy, if you will, and combine that with the power of not paying taxes is pretty darn good when you envelop that with the IRAs and 401ks. And also, let me make this simple for my listeners too. So a lot of my listeners invest in real estate and mostly with real estate notes. And to do that, they form an LLC. And once they form an LLC, which is a company, that company can vote, and it's usually a person of one, a solo LLC, if you will. They're in business, and that business can vote, which means you can vote. You're the owner of the business to open a 401k. That's basically it, right, Dan?
Yeah, that's it. Yeah, you manage it. It's yours.
That's it. So you open that account, and then you start funding that account. And then with checkbook control, they find a note that they want to buy. They fill out the paperwork. The paperwork's going to be, if they're investing direct, I want to ask you about this. If they're investing direct, they would just have the ownership of that note in the Roth 401k's name, not their business name, and they write a check for that. The alternative is, well, maybe there is an alternative to that one. The 401k is a part of the LLC, not separate. All right, now I'm confusing myself here. Yeah, so the 401k is a plan, company-sponsored plan that they have. So they could just buy direct through that and make it that simple.
Yeah, and I would just to super clarify, in the solo 401k, you're the manager of your own plan.
Yeah, right.
You have checkbook access to invest in what you want when you want. Now, and that's across the board because by definition, it's called the individual 401k. Separately in the IRA land, as Dave referred to, if you're with a custodian, there's going to be time and paperwork. If you're with somebody that has I call it the IRA LLC model, meaning you're funding your LLC on day one, there is legally a custodian in the background that says this LLC is a good asset. But then from there, that's what gives you the checkbook control going forward.
Right.
So on the note topic, or our listeners are, as a note seller, if Joe comes to me and has his IRA with another company, okay, that we talked about, I don't even want to do business with him. I want him to have the LLC or the PP, the personal property trust, because of speed and flexibility, which is what you're offering.
It absolutely is. And I mean, when I look at my cap table, let's just say I have more than 2 or 3. I probably have, 30 to 50 different investments at a time. And a lot of these have been wonderfully opportunistic for, especially, and Dave, you're spot on. I mean, talk to a friend, they have an idea, and then you finally learn at the Christmas party that, hey, they finally have that fund and they're letting friends and family in, but it's really going to close for real on December 31st. Yeah, I mean, you come back, it's the 28th, 29th, same day, money goes out. You're not going to see that with the traditional custodian.
Right, agreed. Yeah, that's what I like about what we're talking about.
Yeah, and it can be so important in our business, because how many times have people lost deals simply because they couldn't act fast enough, and somebody else can, and they go, well, I'm going with this person because they're ready to go. I can't wait 30 days, and you're out of that deal. So if you're in the note business and you have an LLC, I mean, you're qualified to open a 401k. You vote for it, you open it up, and it doesn't make sense not to do it. The cost isn't expensive either, right?
From our standpoint, no. I mean, from a rocket dollar, what I commend, Henry Yoshida and the team on is it's flat pricing. As I said, historically, it felt more like the old stodgy model with per transaction AUM. I mean, after sign up for Rocket Dollar's base product, it's a flat $15 a month, aka $180 a year. That's it. And we have folks, I think my one buddy from Morton did 19 deals his first year. Another gentleman, rolled over $1 million to buy, I think a few houses, $15 a month. That's
right. That's cheap.
Wow. That's really great. And one of the ways, and in fact, I was asked as early as I was on a one-on-one session with one of my clients right before this, we were recording this. And one of the topics coming up is, hey, talk to me more about raising capital. And one of the things I mentioned was you've got so much money, and I think even more so now, sitting on the sidelines in these retirement accounts, just looking for something where there's safety, where they can make some decent, safe returns. But there's a lot of cash in that industry sitting on the sidelines. Is that one of the reasons, or one of the things that you did when you set up as an advisor for the BV Capital as well then?
Yeah, so under BV Capital, I'm Series 766. BV Capital is a broker dealer. So, here or anything else, I'm not a CPA, not a CFA, et cetera. This is just, Dan, your fellow passive investor talking here. But, generally what we do see in conversations that we have with folks, I think the desire here is two things. One is, I think more for that monthly or short-term income. I think folks want to see that. They realize 6 months or 9 months goes very quickly. So there's an attraction, for those sort of investments. Otherwise, too, I had some guys I felt, they felt a little too smart. Like, well, my equity portfolio is doing really great. I'm getting, that conversation morphed to, I'm getting some pretty good dividend yield to, okay, yeah, I'm in the red, and it's going to be a while based off of this. So a relatively simple example I share is, let's say a stock's trading at 100 with a 5% yield. That's great, but if it goes down 10%, then you're in the red for a while, and then obviously it can go up or down. Whereas generally speaking, with a passive real estate investment, with an IRA or otherwise, let's say you invest 100, that base tends to stay the same. You get your distributions, which is once again a positive cash flow, and generally speaking, upon sale, you're going to receive your full 100 back and then a share of the profits. Now that's a very vanilla sort of example here, and different things can go in and out. But my main point here is I think folks are starting to realize you're not seeing the volatility in the base, or like the fact that some bonds actually, go negative that folks never realized last year or over, frankly, for their lifetime. So those are some of the things that folks are doing. At the same time, there's folks that are cautioned. They say, hey, 3 to 5 years is a little too long. What do you have in the short term? Or let's say I own a few properties and I'm looking to exchange out. I don't really want to own anymore, but I don't want to pay taxes yet. So I like to say the magic between a 1031 and paying taxes is a DST, a Delaware Statutory Trust. So these are some of the discussions, and we surveyed, our investor base, and this was some of the kind of direct and indirect feedback that we got.
And that invests across the full spectrum of real estate. The funds that you have there.
Yeah, so BV, it's different asset classes, and if not, like I've said, many wise broker dealers, relationships with the likes of a Cantor Fitzgerald or otherwise from a cross-selling agreement. And then separately, just myself, out of kind of dumb luck where my life and career ended up, I have a decade plus in self-storage in a variety of capacities. So I'm still really bullish on that asset class, specifically as a passive investor, but also just evangelizing as here's a part of the living experience in America, and it just so happens to be real estate.
Right.
Yeah, and that's when you think in terms of inflation and things like that. I mean, self-storage, I think, falls in that category of people are going to pay for their stuff, or they're running the risk of losing it. And we see the same thing in the note business, almost as a parallel with that, where, in the notes that we buy, people have some equity in the houses now. The property values have gone up. They've got something to lose there. And Dave and I both spend most of our time in the affordable housing realm. And, people will continue, inflation or not, to keep a roof over the head, and especially in the affordable housing. But I think that draws a parallel over to the self-storage, because people want to kind of keep the same thing, as people have to start to prioritize their bills, that becomes important.
And also with the self-storage, Kevin, and Dan, I know you'll agree with this, it's month to month.
Yeah.
As the economy shifts, you start popping the rates up as far as the renters can afford.
Mm-hmm.
You're right.
A long-term lease.
It's awesome. I mean, storage is great for that. And I like how you mentioned affordable housing. If you can find it, I'm here in Austin, Texas. Tough to find a house.
Yeah.
You have a 2 and 2, you have another child. Whoops, tough to find a 3 and 2. And if you don't want to feel like a hoarder, you do move stuff into storage. And everybody knows that you need the bedroom for your office, etc. But there's also essentials. So it used to be stuff, and then the whole surfboard versus snowboard analogy. But now what you're seeing is, you have your child's winter clothes, your tax documents, true kind of essentials, because as we said, our prices are going up on everything else, probably not to your revenue, whether you're self-employed or otherwise, or W-2'd. And storage is still at a price point where it's not going to break the bank. And frankly, you may have that decision where, that extra bedroom may cost the equivalent of $1,000 a month, whereas a storage facility, maybe an extra 50 or 100 a month.
Right. And also self-storage is running at 0 vacancy factor right now.
I know.
Hmm. Now, so at BV Capital, which by the way, everybody is BV Capital TX as in Texas, B as in boy, V as in Victor, capital TX.com. That's a fund that people, and it has to be accredited investors, if I understand that correctly, that can invest in that. And then those funds are managed by your team and they invest in these assets such as self-storage.
Yeah, so to be specific with BV, we have a triple net industrial fund. It's called the Archway. Our partner is Archway. They have a multi-decade track record of success. This is a diversified industrial portfolio across the state of Texas. We're a year and a half in, consistently paying monthly distributions. It'll be about a 5-year term. Think of the end of 2025 with an equity split. So what I like about it is the manner that we've gone about being a rolling close. So the first 6, soon to be 7 properties in are at extremely favorable debt, extremely favorable prices, and now it's just being smart on what we would add to the portfolio here. So that's one, I'd say, product type. Otherwise, there's a fair amount of one-offs. I'll very loosely say in the multifamily side, and now we're becoming smarter on things that are either currently a DST offering or could be a DST exchangeable offering in the future. And this ranges from beautiful multifamily in Dallas to something like, of all things, a hospital in California. So I joke it's the reverse commute going from Texas to California. But there are some like anything. There's certain plays in certain submarkets that make a lot of sense.
So you can help that because your spectrum is broad.
Yeah, I think
the Roth or the checkbook control or whatever, you can handle all that.
We do, yeah. So in the checkbook control is extremely convenient because there are times, and I'm sure you guys a very dedicated investor base, and sometimes when you say, hey, obviously you're going to go to your current investor base first and say it's probably going to be done in about a week, commitments now, and sometimes you legitimately have to fund by the end of the month or otherwise. So yeah, going full circle on our conversation, this is where the checkbook control is.
Yeah,
it's so much more powerful and easier, for a mutual warm and fuzzy between you and the sponsor.
Yep. Okay.
Very good. Dave, any other comments, questions for Dan?
Dan really covered it. He's very thorough. He has a lot to offer. He's been doing this for more than a day, looking at your resume. So you're just not talking, you're walking the walk, just not talking the walk. That's what I'm gathering. And that's the net from my perspective of you.
Yeah, thank you. I do appreciate it. And I'm pretty transparent to a fault, but I mean, I would say just about all of my active retirement dollars are in a Roth right now. I did a final conversion. And just another high level suggestion, regardless of, I think, markets or anything else, if you do have the liberty to do Roth conversions between now and 2026, could be potentially the lowest tax rate years by a percentage basis. What's the magic number? 314,000 or so is that, especially if your AGI is below this, to start, maybe piecing your Roth, or if you're going to have a quiet year, all my startup founders out there that purposely take no equity, no salary the first year, consider a Roth conversion between now and the next 5 years, especially.
Interesting. Hit me with that one more time. Why between now and when to convert your traditional to a Roth?
Yeah, so to my understanding, once again, not a CPA, et cetera, but for my read is that the tax laws that were implemented a few years ago, from a marginal basis between now and 2026, potentially in 2027, they would evaporate. So I believe, and once again, depending on your lifestyle and everything, but from a marginal, as my CPA says, the magic number is about 314,000. That if you throw on some conversions up till you get to that, and you're probably sitting pretty. It's once again less pain, and obviously you want your little seeds to become big trees, be the next Peter Thiel. But it's I'd even argue, listen, for our friends that are still in the stock market, myself included, for a little piece, did a Roth conversion. Yeah, this might not be the bottom per se, but over the long term, I don't think stocks are going to outperform private real estate, especially from a bottom line basis. But I don't think the party's going to end. I don't think folks are going to say, we're in a down point, we're in a potential recession. I'm going to pull everything out of stocks forever. No, I think some folks are going to sit it out. Some people might, haphazardly sell per se. But listen, a lot of money is going to continue to go on people that work W-2. These are funds that go right into the market. The party's not going to stop. So that's another consideration now. Yeah, you might not hit like the March 9th, 2009 bottom exactly. But I still think over the long term, there's companies that do real stuff out there and people want to put their money, and it'll always, I think for the average Joe J in America, particularly while you're W-2'd, you're limited by default what you could invest in. So this is going to prop up because it does take, I think, a different time and mindset and education to kind of like the three of us to be, I'd say, fully in alts 100%. But I do think this period of time we're in now gives folks a moment to step back this summer and say, I can't be 100% stocks and bonds. Stocks too volatile, also going down, bonds making nothing. What else can I get into? So I'm not recommending put 100%, into real estate tomorrow. But especially thinking of your retirement, I like to say, whatever you do with your piggy bank checking account money, like you own a beach house, you own some land, you invested in a buddy's brewery, you can do this with your retirement dollars. And if there's any, I think, big proof point, and I know Dave and I've seen this, and probably you too, Kevin, on some of these family office shows, they're very open to say, hey guys, we have over 90% of our assets in private real estate, in private offerings, in metal, not in stocks and bonds. And guess what? That's why they're, very wealthy and continue to manage that from a bottom line tax perspective also. So
I have a setup question for you.
Yes.
Do you agree or do you not agree that there are some bubbles in the real estate market and other markets now, and the bubbles will be popping? Second question, if that's true, when will it hit so that our viewers can say, I recognize that as an opportunity, when do I jump in? And I know you don't give advice, this is just your own personal opinion of the way you do things, the way you look at things.
Yeah, so yes, there's definitely bubbles. I don't think there is. I don't think it's going to be a 2008, 2009 episode. For some reasons, almost let's take the opposite of what do you call like a teacup or something first. Places like Tucson, other places in Arizona, still desperately need housing of any way, shape, or form. It'd be a stretch to even imagine in the next 3 to 5 years there's a bubble in AZ. I just don't see it.
I agree.
Coming. Now that said, where we grew up in in Scranton, we joke Binghamton, pick your city up on I-81 in the Northeast there. Things are really cheap. So to say that's a bubble, not as much when you can still buy a decent house with good bones for $80,000. Tough to kind of say where there's a bubble on it. So where a bubble will occur, I think there's some folks that maybe bit off a little more than they can chew, very skinny underwriting, maybe kind of quote unquote forgot to have a debt cap in their underwriting. And once real money transacts and, the bank comes a calling, or they just didn't update their pro forma per se, whether lumber bounced, it's kind of an M-shaped sort of pricing model over these few years on the development side. I think some people will be caught with their pants down. But with that, I think that's more kind of operator and relationship specific, not as much a certain geography, to be honest with you.
All right. Fair enough.
Excellent. Well, we've got to wrap it up, but we could go on for a little bit more here. I'm enjoying the conversation and the insight, and appreciate that. So everybody, look, if you're looking for a really inexpensive way to get your dollars into the tax sheltered, tax deferred accounts, 401ks, IRAs is just a great way to go. And as I said, if you're already in the note business, you have an LLC, guess what? You're qualified. Open an account, start getting those returns tax-free, tax deferred. There's no better way to do it. And definitely check out Dan's website there, rocketdollar.com. And if you're interested in investing into a fund where that's managed for you, you can also check out his other website there, which is bvcapitaltx.com. And Dan, we appreciate it very much. Thanks for the insight.
Awesome, guys. Pleasure to be with you all today. Thanks so much.
You're welcome. And Dave, thanks for being on with us as well. And if you want to reach out to Dave, just Dave at Dave Franicki, or do you have a website you want to throw out there, Dave?
CapstoneCapitalUSA.com.
CapstoneCapitalUSA.com. And of course, my website, realestatewithoutrenters.com. Please check that out. You can follow me on Twitter and Facebook and LinkedIn, all those sorts of things. That's where I put my real estate note investor tip of the day. So I've got a ton of videos, as you probably know, from the YouTube channel. And once again, Dave and I are going to do a special series through the podcast here about how to invest in notes and real estate with these potential of recession, with the current inflation, or potential bubbles that are out there as well. We're going to keep you safe, and we're going to show you how to flourish, just as we did after the last crash. You guys just brought up the crash of 2008. And I'll tell you what, after that crash, the opportunities to create wealth were simply phenomenal. It put the note investment industry on the map, elevated it to its own asset class. Even people, as Dan mentioned, Robert Kiyosaki is fully putting in notes as something that everybody should have in their portfolio. So on behalf of Dan and Dave and myself, thanks for listening, everybody. And please click the like button, give me a nice rating on there, and share the podcast information with a friend. So thanks, everybody. Look forward to talking to you once again.
Bye.